Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs data and how that could affect mortgage rates. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. By the way, I just want to give a special thank you to JP Morgan Chase for getting me a Houston, Texas Chart Daddy t-shirt uniform and having Chart Daddy name in the back. And actually, I think the first jersey I ever had as a kid playing sports, the number was 26 too. So very fortuitous with that number too.
That was awesome. Yeah, Houston Texans coming through there, and then this year it's going to be great. Okay, so this week we now have the government back online, right? Or should, and so Jobs Week. Does that mean we will get jobs data this week, or is that still now put out?
I don't know exactly when the dates we're going to get all the job openings in the BLS, but now that the government's going to be funding, we could prep for that. Before we get into jobs, purchase application data finally got the snow effect into it. It was down 14% week over week, only up 4%. This is what kind of snow or natural disaster stuff does to weekly data. And I always like to remind people when jobless claims, which is a very key weekly data, whenever there's like a hurricane or something like that, jobless claims tend to spike. It takes about 2 weeks and then it comes back down. So with purchase application data, when you have so many people snowed in and not doing anything, it's going to have a decline. And then once you get the weather back up, you get the rebound. You kind of ignore that noise, and then we'll get back to trend eventually.
It's interesting because we wrote the tracker, you wrote the tracker over the weekend, and we didn't see that effect yet. So it took a little bit because, the tracker is weekly data. The
tracker and the purchase application data is taking the previous week. Our tracker is these pending contracts. So it has to get hit this week, or I would be shocked if it doesn't, because a weather thing this size has to impact data, because if people are locked into their homes and nobody's doing anything, you lose that variable, that consumer variable in there. So, but again, it looks normal to me now out there. But trend is still the same. This year is starting the year better than any year we've had, and there's multiple things that are positive this year. Inventory growth is up. Affordability got a little bit better on its own. The spreads are better. But then again, if it's labor over inflation, what about Jobs Week?
Let's talk about Jobs Week. What are you seeing? What are the indicators?
So the ADP report came out, and we're always like, when there's no government data, we're resorting to ADP, and we're like, the time they get a lot of attention. ADP report missed estimates. They were looking for 45,000 jobs created, but only 22,000. Bond yields didn't really react too much. And there's almost like the 10-year yield is doing what I think it properly should do. If the Federal Reserve is hell-bent on just getting to neutral policy as slow as possible, then if the jobs data isn't creating negative jobs, there is no rush for Jerome Powell, the Beth Hammocks, the Lori Logans, the Austin Goolsbys, these people to cut rates, because they don't see that as the problem. All Jerome Powell and the Fed did is have one extra rate cut last year that wasn't planned. So, this year it's like 2 maybe throughout the year. But again, there is no real big rebound in the ADP report. So we'll have to wait for the BLS. But the 10-year yield is at multi-month highs right now. That looks normal to me. The range we gave is 460 on the high end, 380 on the low end. You get to 4 to 380, you better have weaker data to support that. If the jobs data starts to improve, then there's no reason why the 10-year yield shouldn't go higher, because the growth rate of inflation is still 1% off target. And Jerome Powell is not, it does not want to get financial conditions any more easier, especially the Beth Hammocks and the Lori Logans of the world. So that's something we have to keep an eye on with job openings and the BLS report. Now, if everything stays as is, we're just going to kind of be in this lower end of this channel. But this is the reason I had 6.75 and 440 to 460 in the 10-year, is that if the economy outperforms or the labor data outperforms what people say, and we have the lowest bar in the 21st century, then there's your case for higher yields and higher rates to a degree.
Are there any other sources you're looking at besides ADP that you're like, this is giving me an
We have
indication?
some other private sector Revlion and other data lines that we're tracking, and they kind of look all the same to a degree. I think people are waiting to see if there's any reacceleration. And remember that when we think about what the Fed was talking about last year, it was Christopher Waller that was highlighting the labor risk before Powell and the Beth Hammocks kind of had to give in. And what Christopher Waller said last week, that he thinks all the jobs gains can be wiped out in 2025 after the revisions. So the revisions are going to be key, because a lot of times when you get toward the weakness of a labor data cycle, the revisions tend to be very negative. When you start to get in an up cycle, in jobs, the revisions tend to be positive. I used to put a chart out at this, showing like 2 decades of positive revisions and negative. So it's not abnormal to have negative revisions. Just remember, the negative revisions is a small portion of the general workforce. There are over 162 million people working. So when people say 800,000 jobs were not gained or lost in one calendar year, just remember 1.5 to 2 million people lose their jobs every month. That's normal. So we're still somewhat a little bit under normal on the monthly layoff. So in that context, revisions are key, but if there's a reacceleration of jobs, then that's a whole different story. Then you could get the 10-year yield a little bit higher. But we've done enough rate cuts to get down to here. At least for everyone listening, the mortgage rates are near 6%. That is the positive for everyone here. So we want to look at the revisions of BLS. We want to see where the wage growth is. I 100% believe that the Fed really wants to get wage growth down because they feel that's the best way to get to 2% inflation.
Okay, so a little bit, this story continues to twist and turn as far as like the DOJ investigating Powell and the Fed, because of course, we've had a Republican senator say he's not gonna vote for the nomination for Trump's nomination, Warsh, to join the Fed if there's still this investigation. And just this morning, Donald Trump was like, "I'm not stopping this investigation into the DOJ." But we know that could change by the time we're done with this podcast. But it is interesting to me, because to me this is an easy win for him.
So there's another angle to this.
Okay.
Trump doesn't want Powell to stay as one of the Fed governors. He can leave, but he doesn't necessarily have to leave the Federal Reserve. So
Right.
This whole thing isn't so much about Kevin Warsh. This is, hey, listen, if you want to go. We don't want you here. I'll shut it off. They might not publicly say that, but that's what's really going on here. Is that they do not want Jerome Powell part of the Federal Reserve at all. He's not going to be Fed chairman, but he could still be an active governor. So if this keeps on going out, a lot of people say, well, he could just end this and Warsh gets. They do not want him at all. So this is kind of one of those, hey, listen, you can do this. We can make your life easy and just go off. Because I think there's some fear that Powell will stay as part of the Federal Reserve board members, and then he'll just be a pain in the butt to them going out in the future.
So it looks like a game of chicken, because Jerome Powell does not strike me as the type of person who's going to be like, oh yeah, after all of this that I've taken, I'm going to go ahead and just leave on because you're investigating the Fed or me. Doesn't seem like that to me.
Well, there is some rules that if they can't elect, then the Fed board can elect their Fed chairman if there's a vacancy out there. So there's some technical legal stuff on top of everything we're talking about. I know Myron gave up his White House title, which is still crazy to me that he was there and he was Fed. It's just like we're in a strange world anyway. But so I think they're putting their footprint on here, and again the Lisa Cook situation doesn't look
Right.
like, for now that Trump could fire people. So he's going to need all the ammunition he needs with his Fed chessboard game. So this is a game. This is a back and forth game. To me, I feel like the White House is not convinced Powell will leave. And you know, Powell versus Warsh is, that's going to be something if that is part of the process. So it is what it is. This is very abnormal. The whole thing is completely abnormal, but this is the world we're dealing with, and we just kind of play it. So if some people are wondering why does he just call it and so get Warsh
Right.
accepted, this is a game of chicken for Powell. If Powell said, "Hey, listen, I'm gone, I'm done," and we'll take it from there. But that's Powell's only card he has, to play as well.
All of that aside, you still feel very confident in your mortgage rate forecast on the low end and on the high end, correct?
Nothing changes for me because to me the labor data matters more. I think last year was a really good test case where so many people had so many different reasons. Remember, like last year, how crazy it got that people said that we needed to create a recession to bring rates lower because we couldn't finance all this debt, all this treasury supply that was coming. America's broke, and oh my God, we have to create a recession to get rates. It's like all crazy. And again, summer camp. All these people get into like a summer camp, and then they say everybody say this one line together so it makes sense on the internet. And no, so the range stays the same. The labor data is the only thing that moves me. And the reason I say this is 2023, 2024, 2025. Okay, there was all these reasons for rates to stay elevated, but whenever the economy got a growth scare, bond yields went ahead of the Federal Reserve. Now, in the past, in 2023 and 2024, we didn't have weaker labor data. We were presuming that things were getting worse, and then yields would go straight up. Now we don't have the yields going straight up anymore. They're bouncing off of the low end of the forecast, correctly so, because if the jobs data isn't getting weaker, I don't think Powell or the Beth Hammocks or the Lori Logans or the Austin Goolsbys or the Neil Kashkaris are going to say, "Hey, listen, we need to get to accommodative policy as soon as possible." They can easily say that, wouldn't be a problem, but they are just fighting tooth and nail on that one. And again, this is just getting to neutral policy. We have no discussion of accommodative, right? So if the labor data, we don't want it to break, but if it does break, the whole dynamic structure of everything changes. And I think any of you who have seen me live and do my presentations, you know what housing looks like in a recession. We all of a sudden get that next leg lower in rates that we haven't had within a cycle. And then all of a sudden, majority of the people are still employed and, oh, whoa, rates are 5.25. Oh yeah. So that's the history of economic cycles. That's why we want to keep an eye on labor data. And the jobless claims data was always their key, and it's still low. So that's something that by the time this podcast comes out, we get that out. But when Jobs Friday comes, check the revisions, because Christopher Waller said revisions are probably going to lead to negative, flat to negative job growth in 2025. Wage growth is key. Why do we talk about wage growth? Because the Federal Reserve believes old school thinking, 3% wage growth, 1% productivity, because they don't really believe in the product. Actually, Warsh and them believe in the productivity gains, but 1% productivity, 2% inflation. I believe Warsh and Myron and all these people are going to say, hey, productivity gains are great. We can cut rates because of that. That'll be the talking point probably going out for the rest of the year. We'll cross that bridge later when we get there. But for jobs, whenever the labor data comes out, keep an eye on unemployment rate, wage growth, revisions. And we'll take it from there because Powell's just a few more months left before he leaves the Fed chairman role.
Logan, well, thank you as always. We're going to see you next week at the Housing Economic Summit. And our audience, if you have not gotten tickets yet, you should. We're getting close to our number there that we can hold in that room, and it's going to be incredible, because we're not only giving you the economic insight, but also just like the tactical, what you should take from that information and apply to your business. So encourage everyone to come that can come and see Logan in person, do a Q&A with Logan and Barry Habib that I'm going to be moderating. So that will be really fun.
Oh, you're moderating that? Oh boy, I'm going to get stuck.
I am.
Logan, no. Logan, no, stop it.
Listen, this is my specialty is
You know,
moderating
people were talking about that in Houston. They're like, "Oh, Sarah has such a hard job. I bet she has to tell you no a lot." You know, I said, "You don't realize how many times we have to stop this podcast. Do not put that on the podcast. He can't say that." You know,
Yes, I mean it's part of my job, but hey, I'm good at it. So there we go. All right, well, we will see you again soon, Logan. Thank you so much for being on.
pleasure.